But let's get to our top story. Can you trust this rally? That's the question being asked across Wall Street today. Strong retail earnings results pushing stocks higher today. But how long can this last? Joining us now are Ali McCartney from UBS Private Wealth Management, Jim Bianco of Bianco Research. Good to have you both here. Ali, I'll start off with you. And I got to be honest, I read the notes through. And if we played the game, guess the strategist target based on their market outlook, I wouldn't have guessed 4,700 by year end on the S&P 500 from you.
Yeah. So, look, we have come in over the course of the year, and, I think that is still a bit bullish, but we do have some signs that there is reason for hope. Now, in answering your first question, should we trust this rally? I don't think you should trust any day more than another, right? Do I hope that we end the week going into not a ninth week of consecutive downs, and that we can actually get enough support to hold risk on into the weekend? We certainly hope so. But look, yesterday we had the Fed come out with their minutes. It is clear that they are, having two conversations and trying to manage both. On one hand, talking about the need to manage hyperbolic 40-year high inflation with restrictive financial policy, right? On the other hand, they're already starting to talk about what and when that rate pause will be. We don't think we will see that rate pause within necessarily this year, but I think there are a lot of signs that inflation is moving the direction that we needed to move in. We have labor data starting to hint at not being all in the employees' favor, but actual open positions going down and maybe sort of avoiding that spiral of wage price. We have preliminary housing data that we got earlier this week that's showing that financial restrictive policy and tightening is already starting to affect the market. And we are already seeing, as we see services starting to take over for goods spending, goods inflation coming down. So this week, although I can't say that a day or even a week at this point makes a trend, I have loved to see the interaction between bond yields and stock prices going up, and seeing something like consumer discretionaries leading the day with a true risk on. It definitely feels emboldening for right now.
So Jim, I guess, as we stand here at the precipice of the Fed's path towards neutral in terms of their rate hike plans, we're seeing the grit already in the wheels of the economy, right? As Ali had mentioned, we're seeing some, slowdown in housing. We're seeing some uptick in claims. The flip side to this is that we're seeing this, and we haven't gotten to the end of it, and we're already seeing it. And so the Fed really has a needle to thread, so to speak, in raising interest rates, but making sure that you're not destroying too much demand, that you're not slowing, the labor market too much.
Yeah, that's right. The Fed is, the old adage used to be that the Fed hikes until something breaks. But the 2022 version of that is the Fed hikes until enough things break. We've already broken things. We've got the worst stock market in 52 years so far through May 25th. We've got arguably the worst bond market in 200 years. And that's because we've got high inflation and the Fed is trying to deal with it. And I think as we move forward, we're going to have to basically see if we get signs that inflation is coming down, not peaking. Everybody knows it peaked. It probably already has peaked at 8.5%. But that's not the story, and that's never been the story. The story is how fast does it come down? Because if it ends the year at 5%, the Fed's going to go full on the whole year. And their goal is going to be, as former New York Fed President Bill Dudley said, if the stock market doesn't go down, the Fed's going to lower it. That was the title of his op-ed last month. And I think that that's exactly the way the Fed is looking at this right now. If we don't see serious signs of inflation slowing, they're out for the stock market. They have been all year. And I don't think that's going to change, because I don't think we're going to see enough signs of inflation slowing.
I don't know if they're out for the stock market per se, but it certainly is a side effect that they're willing to risk in their fight against inflation. And Jim, I'm wondering, it sounds like you don't think that we have seen any sort of a bottom. For all the optimists out there, your message is we haven't been even close to capitulation. If you take a look, for instance, at the VIX, we've gone not very close to even the 52-week high in the VIX, which is 38.
Yeah, I mean, the Fed uses a euphemism. They call it tightening financial conditions, but that's exactly what they mean by it. They mean that they need people to stop buying stuff, and they need to make people think about stop buying stuff, and that's lowering stock prices. And so they've been very clear on that. I know it's hard for people to get their head around, but you're right. When you look at measures of capitulation, has there been wholesale selling? Has there been a spike in volatility in the options market? The broad answer is no. Now, yes, we had a 100-year string of 8 weeks in a row down in the Dow. That's probably due for some kind of a rally for the next couple of weeks, or at least not going down for the next couple of weeks. But was last Friday the low? I would venture guess is to no.
Allie, just quickly, because we're almost out of time, what sectors
Sure.
got us to 4,700?
That's a great question. So, the sectors that perform well, both in rising interest rates and in above average inflation, those are largely commodities, consumer discretionary, and value oriented sectors, which also at this point in time, coincidentally, line up with geopolitical factors. So if you look back at history, you see the things that you can touch and feel, dividends that you put in the bank, real estate that you can touch, commodities, things that you plant. But again, this is not a short-lived market cycle in terms of volatility. We've seen a lot of volatility this week, whether it's because of pure exhaustion of people like me or of buyers or of people on the institutional side, or whether it's just an obsession and a desire to get to a long 3-day weekend, has seemed much more calm. And we've all been remarking on it on the street than the last number of months. And so what happens next week when we're well into summer, when we have tomorrow's print on PPI, is anybody's guess. But there is no reason to think that we have, quote unquote, capitulated or reached a bottom or gotten substantial information or lack of uncertainty or clarity to get us to some sustainable level before the next couple Fed meetings and CPI and PPI prints.
Can't believe summer's next week. Guys, good to see you, Jim and Allie. We appreciate it.
Thank you.
Bye.
After the break, new data out today shows sellers are rushing to list